The Federal Reserve raised interest rates by 0.75 points this year, the fifth boost of the year, in reaction to the 8.3% increase in inflation this year. But Cathie Wood, the CEO of ARK Invest and a financial expert, thinks the Fed might be seriously mishandling inflation by taking this approach, and she also thinks the organization might be missing some crucial information in the process. Greetings and welcome back to All Things Tesla Stock, everyone. The Federal Reserve has consistently expressed its commitment to reducing inflation rates to the lowest possible level. With the announcement of a third straight 0.75-point rate increase, interest rates have risen to their highest position since 2008, ranging from 3 to 3.25%. The Fed appears to be acting aggressively to lower the inflation rate, which is significantly higher than its benchmark target of 2%, even though interest rate rises usually occur in increments of 25 basis points. In response to the announcement, Wood said that although the Fed might view this as a successful strategy for containing inflation, the end outcome might seriously harm the economy. What are the potential consequences of the Federal Reserve's interest rate hike? And why has Cathie Wood made this statement? To find out, keep watching. To be informed about all that Tesla is up to, remember to like, subscribe, and enable notifications before we get started. The central bank intends to deter spending by raising interest rates, which can lower inflation on the cost of goods and services. There are additional repercussions to this too, such as raising the maximum interest rate on home equity loans to 8% and perhaps raising the monthly payments on newly obtained or variable rate mortgages. While Wood thinks that inflation is the main reason why the economy is falling so much, the financial expert also thinks that corporations will probably experience deflation, which is something investors should be concerned about. Undoubtedly, inflation is having a significant impact on the economy, but this time it's not due to the typical causes. Rather, it's a result of significant, previously unheard of economic shocks. Inflation rates are currently significantly higher than they were in the past, due to variables including the pandemic, supply chain problems, and the Russian-Ukrainian war, rather than the collapse of the currency and rising oil prices. Wood has expressed her worries regarding deflation previously. In her earlier speech on the topic, she asserted that the majority of businesses, particularly automakers, are unprepared for the effects of deflation and that 50% of the S&P 500 is vulnerable to creative destruction. Wood went on to say that if appropriate action is not done, automakers may experience severe deflation in addition to commodity deflation. The stock investor issued a warning in 2021, stating that the biggest threat to the financial markets and the economy in the upcoming years will be deflation rather than inflation. According to Wood, the U.S. economy will grow less than many economists had predicted for the upcoming year. While the Fed's primary focus is on lowering inflation, there might be some other aspects of the process that are being ignored. Deflation can occur when inflation is reduced, and several indicators, as stated by Wood, indicate that deflation is progressively establishing itself in the economy. The used car index is among them. The Manheim Used Car Number Index fell to 204.5, representing a 0.1% decrease from the previous year's number. The research states that September saw a 3% drop in wholesale prices for used cars from August. According to estimates, retail sales of used cars fell 8% in September compared to August and 0% year over year. Wood claims that most people purchased cars on the expectation that the used car price index would continue to rise, enabling them to sell these vehicles at a relatively high price. He also claims that the assumption regarding the residual value of cars is a little high. However, this proved not to be the case. It's possible that fewer people are purchasing used internal combustion engine cars because they're getting harder to maintain rather than because the cars are being produced in greater quantities. Positively speaking, as electric vehicles are becoming more affordable to maintain and are being supported by new laws, there may be a chance for them to overtake internal combustion engine ICE cars in this market. Furthermore, based on Wood's earlier analysis of inflation, innovation might be what saves EV manufacturers. After the creative destruction brought on by inflation, Wood predicted that automakers would struggle. He also mentioned that businesses that are managing their shares in the near term and investing less in innovation could find it challenging to meet the upcoming market challenge. Similarly, automakers whose product lines have the potential to become outdated will likewise need to sell these goods at a loss or face severe financial penalties. In a situation known as commodity deflation, in which stockpiles exceed demand, automakers may need to reduce the price at which they sell their vehicles in order to offset production costs. According to Cathie Wood, only businesses with a competitive advantage in innovation will be able to weather the anticipated deflation. She anticipates that the slowdown in economic growth will lead to a change in the kinds of businesses that can expand no matter what the state of the economy. Given how innovative Tesla has been, supporters of the company will probably exhale in relief at this point. Do you have the same thoughts? Tell us in the comments section below, and if you haven't already, don't forget to subscribe and like the video. Financial specialists like Cathie Wood disagree with the Fed's assertion that its approach is data sensitive. The Fed's remark, according to Paul Molt, portfolio manager at Chicago's Kingsview Investment Management, was rather hawkish. He also noted that price increases are a sign of unpredictable markets and a greater likelihood of recession in the upcoming year. Furthermore, it was a fairly hawkish 75 basis point move, according to Ryan Detrick, chief market strategist at Carson Group in Omaha, and the Fed left the door open for many more rate hikes before the year is up. The dots plots show that more rate hikes than anticipated are on the horizon, and the Fed is prepared to cause significant harm to the economy and possibly the stock market in order to control the out-of-control inflation that has been observed this year. Detrick claims that the economy is rapidly going down and that the Fed's predictions for it are very low. He went on to say that the Fed's interest rate policy might push the dollar higher, which would put more pressure on stocks. However, it appears that the Fed will not be giving up on gaining authority anytime soon. Jerome Powell, the chairman of the Federal Reserve, claims that the organization will not change its position until it is certain that inflation rates are declining. Inflation is running too high, he declared. Much more than that is not necessary for you to know. If there is one thing you know for sure, it is that this committee is dedicated to achieving a meaningfully restrictive policy position and remaining there until we have reason to believe that inflation is beginning to decline. Furthermore, a number of Fed members have stated that before any talk of loosening the policy can happen, they must witness multiple months of inflation that are heading in the direction of 2%. Mary Daly, the president of the San Francisco Fed, discussed this recently in an interview with Bloomberg News. She predicted that the Fed would raise rates to a point where they are restrictive enough to keep inflation under control and then maintain it there, adding that additional policy changes will be necessary to sufficiently manage the economy. The Federal Reserve is still aiming to swiftly raise its benchmark interest rate to about 4.5%, even though its current target range for the rate is 3 to 3.25%. The Fed is ready to raise rates if the high rates of inflation don't start to decline after this, according to a number of officials who have stated that it will take a lot to convince them to veer off this course. This was corroborated by Federal Reserve Governor Christopher Waller, who said, "I don't know how we pause until we see any signs of inflation beginning to moderate." Even with the possibility of an economic slump, the Fed doesn't appear to be close to abandoning its objectives, despite widespread optimism that inflation is steadily declining. In the future, the U.S. Central Bank may raise interest rates for a fourth time in a row by 75 basis points. Although the effects of the Fed's action may not be immediately apparent, Cathie Wood thinks they will be, though other nations might also be impacted by this in addition to the U.S. How do you feel about the remarks? Do you believe that raising interest rates by the Fed to counteract growing inflation is a mistake? Please share your thoughts in the space provided below. If you'd like to see what Tesla has been up to lately, click the next video that appears on your screen. I'll see you over there. Music.